All right, we're back for another episode of the YVR REMO Show, and today we're going to get into who is buying or who's doing what in this current market and why. We've had some interesting transactions to say the least. Certainly we've seen the market slow down quite a bit since the last couple of increases, and we've had a lot of questions from just past clients and partners in the business that are just wondering like, what are we seeing and what's going on. So we thought today would be a great opportunity to chop it up and get into it.
It doesn't matter how slow the market is, there are always going to be certain transactions that happen simply because you can't time the market for everything, right? So there's a handful of different buckets that we'll go over, but I mean, just to kind of hit the biggest one, obviously people in variable rate mortgages are looking at their options right now. Everyone not a lot of people are making changes, but a lot of people are just looking into understanding what the options are, staying the course with variable, converting into a fixed, or doing a refinance. And there are certain transactions that come out of that, certainly not a lot. Like I'd say maybe it's a total guess, but 1 out of 20 people that we talk to actually find themselves in a position where it does make sense to pursue that refinance, take on the cost, what have you. But that is definitely at the top of the bucket for conversations right now. And certain transactions are coming from that. And again, some people that have been making moves, purchasing, what have you, which we'll dig into, but porting, or if they decide to pay off that mortgage and get into something a little bit different, it is still a 3-month interest penalty because you're in a variable mortgage. But more, I guess, uniquely, Tyler or Justin, whoever wants to take it, there are still purchase transactions happening right now. And I've had a handful of people that are just shocked that people are buying homes, but there's still a lot of make sense situations or situations where people have to purchase. So let's start there.
Yeah, I mean the selling and buying or moving within a market, that's always going to happen, right? And sort of the benefit of already being in the market, if you believe the market is down, well, so is the property that you're buying. If you believe your home value is down, well, a lateral move, might come out the wash anyways, right? So still seeing a lot of people, selling and buying. I would say the big one, and we've chatted about this a bunch, and maybe we'll do a full episode on this because there's a few quirks with it, is just a lot of, and I'm sure this is going to be, happening for years to come now. It's multi-generational living, people buying with parents, people combining their either down payment. Like the most common one we see is a parent maybe at retirement age or elderly, or getting there, selling and buying a new home with their children. Their children are working. I mean, the down payment piece. So, we live in the Lower Mainland. To save up a down payment while you're renting is pretty difficult to do, right? Like I would say at least 50%, if not more, of all buyers we help, first time buyers, are getting help from family. I mean, that might even be low 50%. So we're seeing a lot of people take it a step further and just saying, okay, well, wifey and I have good incomes. We can qualify for quite a bit of mortgage money, and parents have this home that's got all this equity. Why don't we just combine forces? They sell their home, take half of it, put down on a new place, and maybe they keep some for their retirement, and then they all live in a maybe 2 or 3 unit property together. So like I said, we could dive deeper into that maybe on another pod, but I would say buying and selling, we're still seeing in a lot of this multi-generational living coming across our desks.
I think too, the other area we've seen with that is a lot of downsizing and moving out of town. Cost of living right now, especially in the Lower Mainland, is extremely high, and people are just wondering if they need their 6-bedroom, 2-bathroom house, and if they can maybe get away with a smaller house in a smaller town. The other side that kind of think is a bit of a surprise is seeing a little bit more rental purchases come up these days. They are buying out of town though, but they're finding places that have similar rents, like Prince George or other markets that are getting cheaper house with maybe a 1 or 2 units in the basement, and finding rents that are quite high cost of the living versus down here.
Yeah, just to echo that, the rental purchases out of market seem to make sense for certain areas. Again, just to Justin's point, to echo that, finding good value on a purchase price in some of these other areas that maybe have also more favorable rental tenancy acts, a bit more control for owners. We're finding that those out of province buyers, from an investor standpoint, do make sense. And yeah, like the amount of moving to other towns and finding new employment for maybe similar wages in other areas, and just far cheaper living, like Alberta, Saskatchewan, Winnipeg as an example. We've had people relocate to Winnipeg. all these things that we couldn't just never imagine seeing previously is certainly coming to fruition. But lastly, first time home buyers, they really don't have much to compare to, right? Like they're not selling and buying, so they're not they don't, as much as those low rates of the low 2% range fixed rates and these rates that had a 1% in front of them, like, first time buyers just don't even know what that is or what that was like, and they have nothing to compare it to. So they're really just looking at like, hey, this is my opportunity to get into a market. I'm going to buy. They had a goal to buy regardless, and they're able to make the down payment work from saving perspective, or maybe bank of mom and dad are helping them out to get into the market. And really they're just comparing their monthly mortgage payment and the total cost to what they would have to pay on a rent perspective. Like everything, rent's gone up quite a bit too in the last couple of years. And a lot of first-time buyers are finding that the total cost of living, from a perspective of comparing it to rent to buying now, is actually very similar.
Just one other piece that we didn't touch on in all this, especially in like the selling and buying process. If you're selling a property and buying a property at the same time, if you have one of those 2% or 3% mortgages, like a fixed mortgage that you can port, it starts to make even more sense, right? Because the new rates, if you're increasing your mortgage, you're only taking the new rates on the new funds. If you're keeping your mortgage balance the same, like you're still borrowing at all-time low interest rate. So there's a major consideration there as well. And I guess just last piece I'd touch on the purchasing, and then we'll go into kind of rate holds, because that's really driven the market over the last few weeks, I'd say. Just affordability, like obviously rates are extremely high, mortgage payments are extremely high. And as much as there's, it's challenging for most, there's definitely a lot of people that can still justify it. Like there's a lot of high income earners in and around Vancouver that, regardless of the situation or the interest rates that we're dealing with, home ownership is more important to them, and looking at big picture. So again, those people that are in that position are certainly fortunate, but again, not everyone's impacted as much as you might think by these interest rates, I guess I'd say.
We always hammer this home how important a rate hold is, and we're really seeing it right now, because what we're seeing, because interest rates there's been such a dramatic change over the last 6 weeks. Anytime we see that amount of change, or maybe mortgage regulation change, we see a big pull forward, right? Anybody sitting on an existing rate hold that might be in the 4.5% to 5% range, like those are all, to timestamp this episode, we're just about into August. A lot of those 4.5% to 5% rate holds are going to start dying out in September, right? So I know we've been very active with people on existing rate holds, trying to get in before their rates increase, because it's not so much, of course, your rate increases, so your cost increases, but it actually affects your purchasing power. I was looking at numbers for a client that might be subject to new rates because they can't find a home that they like, and there's about a 4% purchasing power drop in their application, where they were once qualifying for $750,000 in a purchase price based on their application. If they aren't able to, pull the trigger on something by mid-September, that new max purchase price might drop down to $720,000 for them. So we hit this all the time, the importance of a rate hold. And even if rates are, say, elevated today, like, it doesn't mean you can't change your rate hold. As soon as rates cycle down, we're very active in securing new rates. And also, every bank is a little bit different, right? There's some lenders that'll let us hold an entire rate sheet 1 to 5 years. Some will only let you hold a 25 year, some with a 30. So, if you're working with the right people that have access to as many lending options as you can really capture a whole swath of different rate options that would protect you when we get to these volatile moments in interest rates.
But statistically, the most mortgages are up for renewal are kind of this third quarter coming up here. So we're seeing a lot more of those, and a lot of people are really scared right now, thinking that their mortgage payment's about to go up 40% because they've got the letter from their current lender. But there's a lot of lenders that will let you reamortize. You can potentially switch if you do qualify and move it across to a different lender. Again, it's really important that you start reaching out to Thrive to make sure that you're, a few months out, 3-4 months out before your renewal is up to date. So we can make sure that we have put a rate hold in for you and make sure that you are in the best situation. Now, a lot of clients are seeing possible refinances if they, had their original amortization at 25 years, they're coming up for renewal. They're down to 20 years now. Stretching that back out to 30 will give you some payment relief. There's some options there you have for you, maybe some debt consolidation as well, depending on the equity availability for you. But that's where a really good third party honest opinion is really going to help you through these tough times, especially too, we don't know where rates are going to go. We've hit this on the head so many times now, but structuring yourself now and making sure cash flow is okay will keep you with your mortgage going forward for the next couple of years.
One thing to touch on renewals and just options for people from a restructuring standpoint. If you were somebody that bought in the last 3 to 5 years and your mortgage is up for renewal and you bought with say less than 20% down, there could be a really good opportunity to maybe even potentially lower your payments, surprisingly enough, just by going to the 30-year amortization. A 25-year amortization on potentially a much lower rate than you're going to get today. Again, with the 30-year amortization, you can really lower that payment. And a lot of people might think like, well, that's crazy. I can't be adding that kind of time on my mortgage. I just went from 25 to 20 years remaining, and now I'm bumping back up to 30. That doesn't seem right. And I can totally appreciate that thought process, and I think the best way to look at this is for mainly for just folks that are struggling with payments currently, looking for an option to weather this storm and wait until we get back to a point where rates are a lot lower. That's ultimately how to look at this. Is like, let's say we build a 2-year plan, add a 30-year amortization with a fixed rate. So we have certainty that nothing's going to change from a perspective of payments over the next 2 years, and then just look to restructure and refinance at that point in time when your 2-year term is up, or 3-year, whatever the strategy is. Looking at this as a temporary Band-Aid solution, so to speak. And just jumping into another option that we're seeing is second mortgages and home equity line of credits. This has been super popular for folks that don't want to, that need extra funds for, say, consolidating debts, or maybe doing a renovation, or just investing in anything that might require some additional capital, and don't want to disrupt their current mortgage. We've talked about this in the past. Those really low rates, not wanting to refinance, but just looking to add some extra money in second position, can be very advantageous just from a perspective of preserving the rate that you have in first position.
Well, I can talk about something, some positive news that we've seen. And this is just as recent as last week. And I know we don't like to necessarily name banks specifically on the podcast, but Scotiabank is back, which is huge news for us. And what I mean by that is they've been out. If you've been working in the mortgage industry for all of 2023, even in the end of last year, Scotiabank has basically priced themselves out of the mortgage market for the better part of a year. Not to dive too deep into it, but they basically had some balance sheet issues where they actively tried to slow their mortgage book down, which they definitely did. You say, how do they slow a mortgage book down? They offer really high rates, and they were like, in some cases, I want to say 0.5% to 0.75% more expensive than the competition. And they've been able to dial everything back, reassess everything, and they've just come out with rates that are on par, if not better, than the majority of the lending options available today. And why we're celebrating at Thrive, something I say at least once a week to borrowers is that, common sense left the lending world a long time ago. But of all the common sense deals that do get done from major banks and credit unions, for my money, I'd say Scotiabank is probably the one that does the most somewhat common sense deals. So in a lot of their auxiliary programs that are out there, they have an excellent high net worth program, a self-employed program. So it's just good news overall for anybody in the mortgage business or real estate business, and anybody looking to buy, anybody with a Scotiabank mortgage. If you had a Scotiabank mortgage renewing this year, you were getting offered just awful rates, and it was good for us. We were very successful in moving people out of Scotiabank, but that cost time and money in some situations. But now that they've got themselves realigned and got all their ducks in a row, I think it's just in the 12 months that have been kind of one punch after another, this is just a nice, welcome, positive piece of news.
I mean, back to Dean's point, talking about renewals, and Tyler mentioned the same thing. Like, anyone that's been dealing with that's actively with Scotia, like, you should be touching base with them again to see if you haven't renewed yet, to see if there is any potential to drop your interest rate. But just moving on from that piece, like a couple more of the transactions, and a lot of this stuff we've touched on in previous episodes or emails or what have you, but buyout financing, again, this is something that you can't time, right? Like you don't just pick a time of year to do your buyout. It's typically driven by a life situation, right? A divorce, a business partner's being bought out, whatever the situation might be. And again, not something that you time or plan typically, most people anyways. But that's, again, it's something that we've been seeing more and more of. Buyout financing is, typically there's one partner that wants to buy out the other, and we're trying to pre-qualify them to see if they can actually activate that and achieve that. And if not, it typically falls into a situation where you're selling the property and then one or both people are buying new properties, right? Where a broker would jump in and help with the pre-approval and financing. And I guess just last piece that is really topical right now, like pre-sale financing, right? Pre-sales are typically purchased anywhere from 6 months to 4 years in advance of completion. So, timelines they're never perfect. They're never correct. They're almost always delayed. And literally, like, someone could have had an expected completion date of 6 months ago or 4 months ago when rates were 4.6, if it got pushed out, like, you could literally be taking on a 6% mortgage now just because of timelines with construction and municipality approvals and what have you. But again, these are just situations that, like, they're always going to happen. If a tower or a building or a townhouse development is ready to go, like, you have to close on it and you have to take rates that are being offered at that time. So those are tricky situations, or they can be, because someone that might have, pre-qualified themselves or pre-approved themselves 3 years ago on a 2% rate, there's a good chance they might not qualify for that mortgage today on a 6% rate and 8% stress test. So we always recommend getting in touch like as early as possible, even if it's a year away. We can just start to plan. And if you don't qualify, you can go through the process of adding a cosigner or trying to find additional down payment. Some of that stuff can be pretty hard to achieve. Sometimes, you go through 3 cosigners before you find the one that works.
Make sure you reach out to, if you're thinking about purchasing a pre-sale, there is certain programs out there that can help you lock in your rate today. There's one lender in particular. So that way, if the rates are up like they are now, you can actually be qualified for that purchase even 3 years down the road. It is really important to make sure that you're aligned like that, because I've seen about 4 or 5 different lenders or different clients come through my desk recently that are not qualified for their pre-sale and now have to look at alternative financing methods to close. So it is really important to make sure you do have your ducks in a line as best as possible before making any sort of big investment like that.
Yeah, just a couple comments on both those pieces that you guys mentioned. Buyout financing. What I just want to touch on one piece there, and that's around the unfortunate circumstance of somebody dying. Believe it or not, depending on the lender, you do actually have to re-qualify to carry on the mortgage if your goal is to just continue with the same amount of debt. And in those situations, it's usually somebody that maybe doesn't have life insurance or have any sort of mortgage protection insurance. So if you're sitting in a position where you're not insured and you want some information on that, we work with some really good partners that we could help you with. And at time of purchasing, that conversation about insurance comes up regularly, but it's not always dealt with just because it's not something you really want to deal with at that point in time. But very important to have and at least know what your options are. So something to consider there, because we see a lot of folks that just do not qualify to take over the mortgage on their own, and then they're forced to sell and what have you. So not ideal situations there, but there is solutions there.
We're going to do a full-on episode on reverse financing, but this is something that's becoming more and more common. Like, the most common example that I've seen is, someone that maybe has $200,000 left on their property that's worth like $1.5 million. They'd prefer, like, they've realized, they might be 65, 70 years old. Like, they're probably never going to pay off that balance, yet they're paying $2,000 a month going towards that, when they could actually really use that income on a monthly basis to live a better life or what have you. And those are situations where a reverse mortgage can be massive. And there's a huge black cloud around that word, which seems to be going away. And I know for a fact these products are just going crazy right now throughout our market. People don't want to sell their forever home. They'd rather stay in it, die in it, and make the best of, their late years in life, I guess you could say. So we will circle back and do a full episode on reverse mortgages, but it's something that's becoming far more popular. And I think that black cloud's kind of moving away.
Yeah, they're in high demand, to say the least. And like, there's more lenders doing them. There's a lot more flexible products out there from an age perspective. And yeah, we will definitely do a deep dive in that, just because that's been by far the easiest, most demanded product and topic for us to talk on. So we'll certainly dive there. And it's probably a good point in time to just to wrap this one up. I mean, based on what we talked about, I don't think we missed anything. These are really the hot button topics right now, and the reasons why people are still transacting. And to Derek's point earlier, people are still going to transact. There's still life events and major reasons that you have to get a mortgage and buy real estate, and we covered them all today. So thanks for listening. If you haven't subscribed, please subscribe and make sure you're getting notified on all of our future episodes. And if you have any questions or concerns about what we're talking about, we'd love to hear from you. We're really looking for your feedback, and yeah, we like doing this based on you.